Question 1. Reinsurance contract structure and causes. Which of the following best describes the purpose of the follow the fortunes clause in a reinsurance contract? A. It ensures that the reinsurer pays claims regardless of the primary insurer's underwriting decisions. B. It requires the reinsurer to accept the primary insurer's decisions on claims settlements as long as they are made in good faith. C. It allows the reinsurer to deny payment if the primary insurer deviates from contract terms. D. It sets the maximum limit the reinsurer is obligated to pay under the contract. Answer. B. It requires the reinsurer to accept the primary insurer's decisions on claims settlements as long as they are made in good faith. Explanation. The follow the fortunes clause obligates the reinsurer to honor the claims settled by the primary insurer provided those settlements are made in good faith and within the terms of the original insurance policy. This clause helps avoid disputes and ensures smooth operations between the insurer and reinsurer. Option A is incorrect because the reinsurer is not obligated to pay claims outside the terms of the reinsurance contract. Option C is incorrect because the reinsurer cannot unilaterally deny payment for legitimate claims. Option D refers to retention limits, not the follow the fortunes clause. Question 2. Scenario-based question, catastrophe modeling and risk assessment. Sarah, an underwriter for a South Carolina insurance company, is designing a reinsurance program for a client with properties in hurricane-prone areas. She uses a catastrophe model that estimates the probable maximum loss PML for a Category 4 hurricane to be $50 million. The client wants to ensure they can recover $40 million in losses if an event occurs. Which type of reinsurance arrangement should Sarah recommend? A. A quota share treaty with a 50% participation rate. B. A surplus share treaty with a $10 million retention. C. An excessive loss reinsurance covering losses above $10 million up to $50 million. D. A stop loss treaty for losses exceeding $40 million. Answer. C. An excessive loss reinsurance covering losses above $10 million up to $50 million. Explanation. Excessive loss reinsurance is best suited for catastrophic events as it protects the insurer against losses exceeding a specified retention level. In this case, covering losses from $10 million to $50 million would allow the insurer to manage risks effectively while ensuring sufficient coverage for the client's needs. Option A is unsuitable because quota share treaties do not specifically target large, infrequent losses. Option B does not address catastrophic losses effectively. Option D is incorrect because stop-loss treaties are designed for aggregate losses over a period rather than a single catastrophic event. Question 3. Ethical practices and professional conduct. In the context of reinsurance transactions, which of the following scenarios would most likely violate ethical standards? A. A reinsurer transparently discloses the reasons for denying a claim under the terms of the contract. B. A reinsurance broker accepts undisclosed commission payments from a reinsurer for recommending their services. C. A primary insurer collaborates with a reinsurer to structure a treaty for mutual benefit. D. A reinsurer conducts due diligence before accepting a treaty from a cedent. Answer. B. A reinsurance broker accepts undisclosed commission payments from a reinsurer for recommending their services. Explanation. Ethical standards in reinsurance require transparency and fair dealing. Undisclosed commission payments create a conflict of interest and undermine trust between the parties. Option A aligns with ethical conduct as transparency is maintained. Option C reflects a standard business practice that benefits both parties. Option D demonstrates due diligence, which is an ethical responsibility to ensure sound decision-making. Question 4. Reinsurance underwriting principles. When evaluating catastrophic exposures, which of the following is the primary tool used by reinsurers to assess potential losses from rare but severe events? A. Stress testing of financial statements. B. Actuarial analysis of historical claims data. C. Catastrophe modeling based on probabilistic scenarios. D. Loss development triangle analysis. Answer. C. Catastrophe modeling based on probabilistic scenarios. Explanation. Catastrophe modeling uses advanced software and probabilistic methods to estimate potential losses from severe events such as hurricanes or earthquakes. It evaluates geographical, meteorological, and structural factors. Option A is used for financial health analysis, not exposure assessment. Option B cannot effectively predict low-frequency, high-severity events. Option D is used for claims development trends, not for catastrophic risk assessment. Question 5. Legal and regulatory framework. Under South Carolina insurance laws, which of the following is a requirement for licensing a reinsurer in the state? A. Maintaining a minimum surplus of $5 million. B. Operating exclusively through a U.S. base parent company. C. Submitting annual financial statements to the South Carolina Department of Insurance. D. Providing proof of solvency solely based on self-assessed metrics. Answer: C. Submitting annual financial statements to the South Carolina Department of Insurance. Explanation: Reinsurers in South Carolina must comply with the South Carolina Department of Insurance's solvency requirements, including submitting annual financial statements and adhering to NAICS standards. Option A is incorrect because the specific minimum surplus requirement depends on the type of business. Option B is irrelevant, as foreign reinsurers can operate under specific conditions. Option D is not valid, as solvency must be demonstrated through regulatory guidelines, not self-assessment. Question 6. Types of reinsurance agreements. Which of the following is an example of proportional reinsurance? A. Excessive loss reinsurance. B. Aggregate stop-loss reinsurance. C. Quota-share reinsurance. D. Catastrophe reinsurance. Answer: C. Quota-share reinsurance. Explanation: Quota-share reinsurance is a type of proportional reinsurance where the reinsurer and cedent share premiums and losses in a fixed percentage. Option A and B are non-proportional reinsurance types where only losses exceeding a specific threshold are covered. Option D refers to a reinsurance product focusing on catastrophic events, not specifically proportional arrangements. Question 7. Scenario-based question: Reinsurance accounting and financial reporting. David, a reinsurance accountant, is preparing the annual financial statement for a South Carolina-based insurer. He notices a discrepancy in reinsurance recoverables where the reinsurer disputes the valuation of losses. How should David handle this situation according to statutory accounting principles SAP? A. Write off the entire disputed amount to avoid delays in reporting. B. Report the disputed recoverables as an asset without adjustments. C. Adjust the valuation to reflect only the portion agreed upon by the reinsurer. D. Exclude all recoverables from the statement until the dispute is resolved. Answer: C. Adjust the valuation to reflect only the portion agreed upon by the reinsurer. Explanation: Under statutory accounting principles SAP, disputed reinsurance recoverables must be adjusted to reflect only the agreed upon amounts to maintain accurate and reliable financial reporting. Option A is incorrect, as writing off the entire amount disregards valid claims. Option B overstates the assets, violating SAP standards. Option D is incorrect, as it excludes valid recoverables unnecessarily. Question 8. Catastrophe modeling and risk assessment. What is the primary advantage of using aggregate excessive loss reinsurance for an insurer operating in South Carolina? A. It protects against individual large losses exceeding a predetermined limit. B. It limits cumulative losses over a policy period, reducing financial strain. C. It provides proportional sharing of both premiums and claims. D. It exclusively covers catastrophe-related events such as hurricanes. Answer: B. It limits cumulative losses over a policy period, reducing financial strain. Explanation: Aggregate excessive loss reinsurance covers an insurer's total losses during policy period once they exceed specified amount. This protects against the cumulative effect of multiple smaller claims. Option A refers to per occurrence excessive loss reinsurance. Option C describes proportional reinsurance. Option D incorrectly limits the scope to catastrophes, which are not exclusive to this type of reinsurance. Question 9. Ethical practices and professional conduct. Which action by a reinsurance intermediary would be considered unethical under South Carolina regulations? A. Facilitating communication between a cedent and a reinsurer. B. Misrepresenting terms of a reinsurance treaty to secure a deal. C. Advising the cedent on optimizing its reinsurance program. D. Disclosing commission rates to all parties involved in the transaction. Answer: B. Misrepresenting terms of a reinsurance treaty to secure a deal. Explanation: Misrepresentation violates ethical standards and South Carolina regulations. Intermediaries must act transparently and fairly to maintain trust and integrity. Option A, C, and D are acceptable practices that comply with ethical guidelines and foster professionalism in reinsurance transactions. Question 10. Reinsurance market dynamics. How does economic recession typically impact the South Carolina reinsurance market? A. Reinsurance premiums decrease due to reduced risk exposure. B. Demand for reinsurance increases as insurers seek to reduce capital strain. C. Reinsurers offer broader coverage to attract more business. D. Insurers reduce reliance on reinsurance to cut costs. Answer: B. Demand for reinsurance increases as insurers seek to reduce capital strain. Explanation: during an economic recession, insurers often face financial strain and seek reinsurance to mitigate risk and maintain solvency. Option A is incorrect because premiums may rise due to increased risk. Option C is not typical as reinsurers might tighten terms. Option D contradicts market behavior as reinsurance is more critical during financial downturns. Question 11. Reinsurance contract structure and clauses. Which clause in a reinsurance agreement obligates the reinsurer to follow the underwriting decisions of the cedent as long as they are within the terms of the agreement? A. Arbitration clause. B. Follow the settlements clause. C. Follow the fortunes clause. D. Termination provision. Answer: C. Follow the fortunes clause. Explanation: the Follow the Fortunes clause ensures the reinsurer adheres to the underwriting decisions made by the cedent, provided those decisions are in line with the reinsurance agreement. Option B refers to claims settlements, not underwriting decisions. Option A relates to resolving disputes, while option D governs contract termination. Question 12. Risk management and reinsurance optimization. An insurer in South Carolina has a highly diversified portfolio and low frequency of catastrophic claims. Which reinsurance structure is most cost-effective in this scenario? A. Quota share reinsurance. B. Aggregate stop-loss reinsurance. C. Excessive loss reinsurance. D. Proportional surplus share reinsurance. Answer: C. Excessive loss reinsurance. Explanation: excessive loss reinsurance is cost-effective for insurers with low claim frequency as it covers losses exceeding a specific threshold. Quota share and surplus share are proportional structures less suitable for this profile. Aggregate stop-loss is ideal for cumulative risk but may not be necessary here. Question 13. Types of reinsurance agreements. Which of the following reinsurance agreements provides coverage based on the total insured value (TIV) rather than individual claim limits? A. Facultative reinsurance. B. Treaty reinsurance. C. Parametric reinsurance. D. Aggregate excessive loss reinsurance. Answer: C. Parametric reinsurance. Explanation: parametric reinsurance provides coverage based on predefined parameters, such as the total insured value (TIV), rather than individual claim limits. Facultative A and Treaty B reinsurance focus on specific risks or groups. Aggregate excessive loss. D covers cumulative claims over a threshold. Question 14. Scenario-based question: claims management in reinsurance. MS. Bennett, a claims manager for a South Carolina-based insurer, receives a reinsurance claim rejection from the reinsurer, citing improper notification of the original loss. Which course of action should MS. Bennett take to resolve this issue under industry standards? A. File a lawsuit immediately to enforce payment. B. Seek arbitration as per the terms of the reinsurance contract. C. Negotiate a settlement directly with the reinsurer. D. Write off the claim to avoid further disputes. Answer: B. Seek arbitration as per the terms of the reinsurance contract. Explanation: reinsurance contracts typically include arbitration clauses for dispute resolution. Filing a lawsuit A may breach contract terms. Direct negotiation C is possible but secondary to arbitration. Writing off the claim D disregards recoverable amounts and is not a standard approach. Question 15. Solvency regulation and financial standards. What is the primary purpose of solvency regulations for reinsurers in South Carolina? A. To prevent cedents from retaining high-risk policies. B. To ensure reinsurers can meet their financial obligations. C. To reduce the premiums charged by reinsurers. D. To limit the market share of international reinsurers. Answer: B. To ensure reinsurers can meet their financial obligations. Explanation: solvency regulations protect policyholders by ensuring reinsurers have sufficient financial strength to honor their commitments. Options A, C, and D do not reflect the core purpose of solvency regulations. Question 16. Catastrophe modeling and risk assessment. Which metric is most commonly used in catastrophe modeling to determine the potential maximum financial loss from a single catastrophic event? A. Probable maximum loss (PML). B. Expected annual loss (EAL). C. Loss ratio. D. Reserve development. Answer A. Probable maximum loss (PML). Explanation: PML estimates the highest financial loss likely from a single catastrophic event, helping insurers and reinsurers prepare adequate reserves. EAL. B. Reflects average annual losses. Loss ratio. C. Measures profitability and reserve development. D. Tracks claim reserves over time. Question 17. Emerging trends and challenges. How is climate change affecting the South Carolina reinsurance market? A. It reduces the demand for catastrophe reinsurance. B. It increases the frequency and severity of catastrophic losses. C. It eliminates the need for reinsurance optimization strategies. D. It stabilizes reinsurance premiums due to improved predictability. Answer B. It increases the frequency and severity of catastrophic losses. Explanation: climate change is linked to more frequent and severe natural disasters, increasing the demand for reinsurance to cover escalating risks. Option A contradicts market trends. Options C and D oversimplify the complexities introduced by climate risks. Question 18. Reinsurance intermediary conduct rules. Which of the following practices violates South Carolina regulations for reinsurance intermediaries? A. Disclosing commission rates to all parties. B. Retaining premiums for longer than the contract permits. C. Acting as a consultant for both cedents and reinsurers. D. Facilitating premium collection on behalf of the reinsurer. Answer B. Retaining premiums for longer than the contract permits. Explanation: retaining premiums beyond the agreed period is unethical and breaches fiduciary responsibilities. Options A, C, and D align with standard practices if done transparently and per contract terms. Question 19. Reinsurance program design. What is a primary consideration when designing a reinsurance program for a South Carolina insurer with significant hurricane exposure? A. Choosing the reinsurer with the lowest premium rates. B. Limiting the reinsurance program to facultative coverage. C. Ensuring coverage includes catastrophe reinsurance layers. D. Reducing the retention level to the lowest possible amount. Answer C. Ensuring coverage includes catastrophe reinsurance layers. Explanation: hurricane-prone regions require catastrophe reinsurance layers to manage extreme losses effectively. Selecting reinsurers based solely on premiums A ignores coverage adequacy. Facultative coverage B is unsuitable for broad risks and excessively low retention levels. D can be financially inefficient. Question 20. International reinsurance and cross-border considerations. What challenge might a South Carolina insurer face when dealing with international reinsurers? A. Difficulty complying with NAIC model laws. B. Exposure to currency and regulatory risks. C. Limited access to proportional reinsurance. D. Lack of catastrophe reinsurance options. Answer B. Exposure to currency and regulatory risks. Explanation: cross-border reinsurance often involves currency fluctuations and differing regulatory environments. Options A, C, and D do not address the specific complexities of international transactions. Question 21. Reinsurance recoverables and solvency. What is the impact of a reinsurer's credit rating on an insurer's financial stability? A. It has no direct impact. B. It determines the reinsurer's tax obligations. C. It affects the valuation of reinsurance recoverables. D. It limits the types of policies an insurer can underwrite. Answer C. It affects the valuation of reinsurance recoverables. Explanation: a reinsurer's credit rating influences the insurer's assessment of reinsurance recoverables. Poor ratings may require additional reserves for potential defaults. Options A, B, and D do not accurately reflect this relationship. Question 22. Catastrophe bonds in risk management. How do catastrophe bonds benefit insurers in South Carolina? A. They eliminate the need for reinsurance contracts. B. They provide high returns regardless of market conditions. C. They transfer catastrophe risk to investors. D. They reduce policyholder premiums directly. Answer C. They transfer catastrophe risk to investors. Explanation: catastrophe bonds allow insurers to shift risk to capital markets, ensuring liquidity after disasters, while they enhance risk management. A. Do not replace reinsurance. A. Or directly reduce premiums. D. Question 23. Retrocession in reinsurance. What is the primary purpose of retrocession in the reinsurance industry? A. To provide direct coverage to policyholders. B. To allow insurers to bypass regulatory requirements. C. To enable reinsurers to manage their risk exposure. D. To reduce underwriting costs for primary insurers. Answer: C. To enable reinsurers to manage their risk exposure. Explanation: retrocession allows reinsurers to transfer part of their assumed risk to other reinsurers, spreading exposure. Options A, B, and D do not reflect retrocession's function. Question 24. South Carolina insurance regulations. Which body primarily regulates the reinsurance market in South Carolina? A. National Association of Insurance Commissioners (NAIC). B. South Carolina Department of Insurance. C. Federal Insurance Office (FIO). D. Reinsurance Association of America (RA). Answer: B. South Carolina Department of Insurance. Explanation: insurance regulation, including reinsurance, is managed at the state level in South Carolina. The NAIC provides model laws but does not regulate directly. Question 25. Proportional versus non-proportional reinsurance. Which statement best describes a key difference between proportional and non-proportional reinsurance? A. Proportional reinsurance covers losses exceeding a set threshold. B. Non-proportional reinsurance shares premiums and losses proportionally. C. Non-proportional reinsurance requires a retained limit before coverage applies. D. Proportional reinsurance eliminates insurer retention requirements. Answer: C. Non-proportional reinsurance requires a retained limit before coverage applies. Explanation: non-proportional reinsurance, such as excessive loss, applies after losses exceed a defined limit. Proportional reinsurance involves sharing premiums and losses, not thresholds. Question 26. Emerging risks in South Carolina. Which of the following emerging risks is likely to influence reinsurance strategies in South Carolina? A. Increased competition among local insurers. B. Rising coastal flooding due to climate change. C. Decrease in overall policyholder claims. D. Reduced reinsurance capacity in global markets. Answer: B. Rising coastal flooding due to climate change. Explanation: climate change heightens risks like coastal flooding, necessitating advanced reinsurance strategies. Options A, C, and D may occur, but are less directly tied to emerging risks in South Carolina. Question 27. Reinsurance pricing. What factor has the greatest impact on the pricing of catastrophe reinsurance for hurricane-prone areas? A. Historical claim frequency and severity. B. Premiums charged by primary insurers. C. The cedent's underwriting practices. D. The type of retrocession agreements used. Answer A. Historical claim frequency and severity. Explanation: reinsurance pricing is heavily influenced by historical loss data in hurricane-prone regions, while underwriting practices C and retrocession D affect pricing. Historical data is most critical. Question 28. Reinsurance program monitoring. Which metric is most commonly used to evaluate the effectiveness of a reinsurance program? A. Expense ratio. B. Loss ratio. C. Combined ratio. D. Solvency margin. Answer: B. Loss ratio. Explanation: the loss ratio indicates the proportion of claims paid relative to premiums earned, offering insights into reinsurance program performance. Other metrics are relevant but less focused on reinsurance impact. Question 29. Scenario-based question. Arbitration in reinsurance disputes. An insurer in South Carolina is involved in a dispute with a reinsurer over claim payments. The reinsurance agreement includes an arbitration clause, but the reinsurer is uncooperative. What should the insurer do next? A. File a complaint with the NAIC. B. Proceed to arbitration as outlined in the contract. C. Initiate a lawsuit in state court. D. Suspend premium payments to the reinsurer. Answer: B. Proceed to arbitration as outlined in the contract. Explanation: arbitration clauses are binding and enforceable under reinsurance agreements. Filing lawsuits C or complaints A without arbitration violates contractual obligations. Option D could lead to additional disputes. Question 30. Reinsurance is a risk mitigation tool. What is a key advantage of using reinsurance for a small insurer in South Carolina? A. It guarantees profitability in all underwriting years. B. It allows the insurer to write larger policies than its retention limits. C. It eliminates the need for regulatory compliance. D. It reduces the insurer's marketing expenses. Answer B. It allows the insurer to write larger policies than its retention limits. Explanation: Reinsurance supports small insurers by enabling them to underwrite policies beyond their retention capabilities while managing risk. It does not guarantee profitability or eliminate compliance requirements.